Hello and welcome to a brand new episode of Mind Over Money, a show where we talk about ways and how meditation, yoga, and behavioral science can help you become a more efficient trader, investor, as well as a better human being. Well, my name is Shraddha Janand, and today we have with us a very special guest, Abhijit Chokshi, who's a founder of Stockifi. Welcome to the show, Abhijit.
First of all, thank you, Kshitij, for giving me this opportunity.
Right, welcome to the show, Abhijit. And today we'll be talking about the behavioral aspect of investing. So, how your mind can become your worst enemy in investing. I think our viewers would want to know more about that. And you've in your website, Stockify, Investor, those you've mentioned a lot about it. Tell us more about it.
Correct. So let me start with a question. How about when was the last time you ignored an investing opportunity just because it was up by, let's say, 30 to 50%
Right.
in the preceding months? By any chance, you have such example?
Well, I'm sure not me, but I'm sure a lot of our viewers would have come across this kind of, you could say this question or this opportunity, and they would have been perplexed as to what they want to do at this point in time.
Okay, so let me just share my story with you. So
Sure.
this was back in 2013. I was just in the initial phase of my career in the stock market.
Okay.
And there was a company called Ajanta Pharma. So
Mm-hmm.
it was trading around 60 odd levels, and I did all the research, and it was very attractive. So I ended up buying a good chunk,
Sure.
and just within a few months, it shot up to 120. And I had never seen such kind of returns. Like 100% for me back then was a massive return. So I was like, oh, ये तो बहुत हो गया. Let me just exit this, and maybe when it will fall back, I'll get back into it. So I sold out everything at 120, and then I started monitoring the stock price.
Mm-hmm.
So it went to 150. Then I'm like, okay, let me just wait, let it fall a bit lower, then I'll buy. Then it again shot up to 200. So I'm like, okay, अब 150 पर आएगा तब I'll buy it. So like that, it went on going, and literally I missed a 20x story. Now, the reason was that I somehow anchored my mind to my selling price, which was 120.
Mm-hmm.
So in psychology, this is called as a classic anchoring bias.
Okay.
Let me share a recent example. So at Stockifi, we have these recommendations
Right.
where we give to our clients. So one of the recommendations was a persistent system. It's an IT company, right?
Mm-hmm.
So the recommendation came at a price of 1100, and it was a 52-week high at that time, and the stock had just doubled in just last few months. So a lot of my clients, they did not buy it. In fact, they are like they were complaining कि boss अभी stock double हो गया और आप दे रहे हो, it's
Mm-hmm.
already at 52-week high, what logic is this? And um, but then there was some lot who did actually end up buying, and the price went 4x in just next 8 months.
Right.
So when we analyze these both examples carefully, the one thing is
Mm-hmm.
common is that by default our minds are fixated on price,
Sure.
and that's one of the major mistake beginners do. In fact, I also did the same, and then because of that, I
Mm-hmm.
made massive blunders, losing a lot of potential multi-baggers, right? And there is also one thing I'd like to mention. This is something which I have also noticed, that people are somehow uh, they just love averaging down. Like if let's say they buy a stock at 100 and the stock becomes 80, the most queries I get is कि sir इसमें average कर सकते हैं, can we buy more? And when a stock goes from 100 to 120, most people would not ask for averaging it then. So there's somehow then I wanted to understand why is this the reason. So then again there is a theory in behavioral finance called loss
Mm-hmm.
aversion theory. So
Mm-hmm.
as per that theory, it is proven that the pain of losing is twice versus the joy of gaining. So that's the common observation, and there are these nuances which our mind carries, which leads us
Mm-hmm.
to make such decisions, which lead us to a lot of blunders, especially in the financial market.
Right. Well, definitely, there are interesting point that you've made on or about biases. So, why do investors all suffer from these human biases or behavioral biases? We could say that.
Correct. So to answer that, let's get back in time. Let's say almost 1 lakh years ago, especially during the hunter-gatherer period.
Right.
Now, just imagine 1 lakh years ago, you are also a hunter-gatherer, and then you see a bunch of people who are just running hastily in a jungle. And obviously, there is no time to analyze the situation. Like, would you just stay there and try to think why they are running, or would you just join them and just be part of the crowd? Obviously, you would join
Absolutely.
them, right? Because if
After
you were
the
to wait, correct, right? So if you were to wait and analyze, you would end up becoming food for the lion. So the answer lies in the fact that our brains have been hardwired over centuries, over lakhs and lakhs of years of evolution. And during that caveman era, the way we had to make decisions were way different from the era which we are living right now. And exactly, there are these patterns which our brains have formed. They become an hindrance when it comes to rational decision making, and especially in the stock market, where you must be dispassionate as much as you can while making a
Right.
decision. So there was a study done by Kahneman, and they came up with a conclusion that our brains, they work at two level. Like, our thinking is basically divided in two. So one is called, let's say, system one thinking and system two thinking. I would like to call it a system B versus system C. So let me give you an example. So let's say if I ask you 2 plus 2, your mind would directly say 4. So that is system B, like B for basic. So any kind of decision where there is very simple um, decision making is involved, the system B would get activated and you get the answer. And system C would work when there is some kind of a complex calculation. So let's say if I ask you 35 times 42, for example, right? So in that previous example, for example, when we were running, everyone was running, and we joined them. Our system B got activated, and we immediately joined them without thinking anything. Or it could be, let's say, if we are dealing with a complex question, like for example, choosing a life partner. So obviously, you would rather spend some time with them, think about various angles, and then take a call. So in such kind of scenarios, system C is predominant. And also, I would like to share that in those days we used to be in groups, like groups of 150, 200 people. We were part of a community, and uh, being not accepted by the group meant you would be an outcast, right? So that would mean that you would probably die of starvation, or you would get rid of security, which was the essential survival toolkit. Now today, things are obviously not the same, but yet we are carrying some parts of that caveman brain. Now, when it comes to stock market, we know that following the crowd is the best way to lose money in the market. In fact, markets function in a way that it literally ridicules the majority almost every time. Like 80 out of 100 times, it does ridicules the majority. So yeah, to sum it up, because there is a gap between the way our brains inherently work and the system of finance is designed in such a way that there is a gap. So that is the reason we end up committing this mistake repeatedly.
Right. So things are more internal, and we just have to overcome these behavioral biases, as we move forward in our investing journey, and definitely other aspects of life as well. So now that we know about these biases, so Abhijit, tell us what are the next steps? How can investor one can come out of this?
Correct. So the solution which I have figured out over these years is very simple, is basically keeping a journal. Now, I'm sure you have heard about how journaling can be a good way to sort out your life.
Absolutely.
In the same way, having a trading journal or an investing journal per se definitely did help me when I started my journey, and then I read about how journaling can help me. So let me give you a very simple two-step process. So in the first step, what you have to do is you have to maintain a journal in which what you will be doing is every time you make a buy or sell decision, you just have to write down at least 5 reasons. So for example, let's say you are liking Reliance and you're buying it. So you have to write what are the 5 reasons you are buying this stock at this price. What it could be anything. It could be like you're finding this thing attractive, or this is the reason, or it could be as simple as you have been monitoring this company and now there is a turning point. And the same thing you have to do when there is a sell decision to be made. So you, whenever you are selling, you just write down why are you selling. Is it because you think the price has become valued, it has become overvalued, or
Okay.
you think there is no more room left? So those kind of things you have to write, just 5 things. And trust me, initially when I started, it was very difficult. So even writing 2 or 3 reason is it sounds easy, but when you actually sit and write down 5 reason, it does it, like your brain would require some effort. So over a period, you will collect the data. Now, what will happen? Let's say now 6 months down the line, let's say you have made maybe 15 or 20 such buy and sell decisions. So you will be able to analyze this data over a period. So when after 6 months down the line, let's say you had bought Reliance and then now it performed in XYZ fashion. So now you will be able to realize that, okay, your logic was, this was the logic to sell. Now this price has done. So whether you were right or wrong, you will end up learning while reviewing your own reasoning. So over a period, this thing did help me be careful. So now let's say if I had made a decision based on X factor, now over a period, I learned that, okay, these are the things which I should not be doing in future, which I have done it. So this way, those reasons will become hardwired, and you will end up at least saving yourself from committing similar blunders.
No, interesting points there, Vijit. I'm sure our viewers would take note of that, because these are important things whenever in your investment journey and whenever you're buying or selling a stock. Now, Abhijit, tell us something. Long term is how long, according to you? To make money, we should follow the Warren Buffett's advice to buy and sit, or keep working on the investment idea. So, what are your views on that?
Correct. So for me, anything beyond 2 to 3 years is what I consider long term.
Okay.
And this has been a very hot debate. Like, is buy and sit a strategy which is something one should inculcate? So in my experience, I would say that it definitely depends. Like, for example, if there are groups like HDFC Group or Reliance, these guys, these groups are here to stay put for very long periods of time. So in this case, the buy and forget approach would work, where you just have to do an SIP or just buy these quality companies at every interval, and over a period you will have like a decent let's say 13-14% kind of a CAGR returns on that portfolio. However, majority of the companies do need an active tracking, as in monitoring their quarterly earnings, actions of the management at periodic interval, tailwinds in the sector. And in fact, I like to share in the community, there is a saying that if you learn kya takwu, atakwu and chataku, to life ma latakwu nahi pade. So let me explain that. So basically what it means that tikna, as in where to keep at it, like where to keep pushing. Correct, where to stay put. And ataku, as in where to hold, like where to just hold your horses and where to just wait and introspect. And chataku means completely run away or exit. So life mein fir latakna nahi padega. So basically it's either life or stock market. If you learn where you have to stay put, in especially in which stock you have to keep on investing more, in which stock you have to hold, and at what point you have to exit completely. So if you master these 3 skills, you don't have to basically get stuck in either it's a stock market or in life. And I understand that doing this specifically, doing this on a part time is very difficult.
Very difficult.
Especially being everyone having their full time business or full time profession. So that's where you need like a financial advisor who has spent enough time in the markets and who can do this tracking on your behalf.
No, absolutely interesting points there, Abhijit. Now, so what would be your advice to new investors, especially the ones who've just joined the D Street party, you could say, 2 years back, especially after COVID 2020. So what would you guide them, or how should they look at their investment journey?
Right. So I consider investing as the only sport in which there is no retirement. So investing is basically the game of your mind, right? So one of the things which I noticed is that being in circle of similar profession people, like I used to only interact with people from my industry. So every time we end up talking about stock market or finance or global macros in general. And that led to a state of mind where आप कुएं का मेंढा type situation. So you become privy to similar kind of data, and
Right.
uh, that does lead to like a lot of biases, which we were discussing initially. So what the first thing which I would recommend is to keep your mind stimulated. Now it could mean that talking to people from different industries, or it could be as simple as learning a new skill like a piano, or maybe learning a new language. And the most important thing I would like to share with everyone is that, guys, there is no shortcut. There is no alternative to keeping your eyes and ears open and spending time in the market.
Right.
Now, like we call it paying tuition fee. So one would only graduate in the market by witnessing at least one or two full cycles,
Good.
and you have to pay tuition fees, and for that you have to be willing to do that and be patient. So that's a very generic thing. And also I would like to mention this thing that you have to enjoy the process, right? Like anything in life, if you are just forcing yourself to be an investor, you will never become one. In fact, all you will be is be more miserable, right? And other things I would like to share is that learn as much as you can about different businesses. At the end of the day, what we do is that we are practically in the business of businesses, right? And what I've noticed is that a lot of people, they read a lot of books or way too much on how to become a better investor, rather than spending time on learning how businesses works, or basically understanding their business models, etc., right? So focusing on the latter part would something I encourage everyone who has entered new in the market. And let me share that one key thing which I do, which to learn about new businesses and how they make money, is I try to attend as many these fairs as possible. There are these different expositions happening
Absolutely.
across
Yes. Yes.
the country. So, for example, recently I had been to a plastic exposition. So there I got an opportunity to meet with a lot of listed plastic company players, and I got to interact with their marketing team. So if I have any questions about that sector, I can ask them. I can ask them, yeah, business kaisa chal raha hai, what are the challenges they are facing, and I could gather those raw inputs, the ground level inputs, which helps me research a stock better, right? And also, the one thing which I would like to emphasize is that keep your winners and cut your losers as early as possible. So the loss aversion thing which we discussed earlier,
Yes.
it is very prevalent, and I've noticed everyone struggling with that. People, just because if something thoda sa bhi wo green mein aaya, thoda sa bhi, if it is making a profit, when I tell them to exit something, they would, by default, their mind would go कि चलो इसको exit कर देते हैं, थोड़ा profit मिलता है, अरे इसमें loss हो रहा है, let's hold it, right? So
Right.
our minds are designed in such a way, but exactly opposite needs to be done. If something is showing strength, it is to be held on to, and if something is losing you money, be very careful and try to cut out those losers as early as possible. And the last thing I would like to share is stay humble and respect Mr. Market, because at the end of the day, every day a market teaches you something new, and one has to be a student of the market. There is no other alternative.
Duly noted, Abhijit. In fact, all these key pointers that you've laid out for new investors, these are very important ones, and I'm sure our viewers would take note of that, and that will help them in their investment journey. Now, staying with the new investor theme, so there's nothing wrong in seeking crorepati dream, why equity investment. So, what are the things or any checklist which one should sort of keep a note of?
Correct. So let me answer this in two parts. So the first thing which I have noticed while interacting with numerous investors,
Sure.
that most of them, one is they don't have an emergency fund,
True.
and they've never created a financial plan. So during COVID, I think everyone realized the importance of emergency fund, right? So the standard formula for that is just note down your monthly expenses, multiply it by around 10 to 12 months, and ensure that you have at least that buffer as an emergency fund parked in a liquid fund or in an FD where it's immediately accessible, right? So once that emergency fund is sorted, then the next step would be to create a financial plan. It's basically making a budget and try to stick to it. Once that is done, the another important thing I would like to share is make sure that you don't invest in the markets until you have any sort of the debt on you, right? So most people do this mistake of कि अरे market में इतना returns 25-30% मिल रहा है and I'm getting a loan at 6%, 8%, so let me just take leverage and then invest. So that is something I would not encourage anyone to do it, because one should only start investing once they have paid off all their debts. And practically we say this, that you should only invest your money in the market which you don't require for next 2 to 3 years.
True.
And once you are done with that, then the part of investing comes. So in investing, either there is one thing whether you would hire an investment advisor to do that on your behalf, or in case if you want to start on your own, I have a small checklist before you actually boil down to a company. So it's a very 5-pointer checklist which I use. I have in fact tweeted also multiple times. So it's the first question which I would ask before studying a business is that whether this business is a cyclical or non-cyclical.
Okay.
And then I would see that, okay, now that I've figured out the nature of the business, are there any presence of tailwinds in the sector? So basically, is the sector showing any signs of momentum? And one of the things which I specifically notice is I try to see whether the stock is hitting all-time high or 52-week high. Now, if you notice, most of the new investors, they are afraid of investing in the companies which are hitting 52-week high, right? So what I suggest is, like, in a simple terms, let's say if a student is getting a first rank in the 5th standard, right? And chances of him getting the first rank in the 7th standard are high, right?
High, yes.
Not a student who is performing in the bottom half. So in the same fashion, if a stock is showing 52-week high, or if it's continuously coming in the 52-week high or all-time high range, then one should pay a specific attention to it, right? And the third thing I would like to share is that make sure that the company is generating enough free cash flows.
Okay.
And the fourth thing is the consistency in the ratios. So basically, what the company is doing with the money that is generating, how it is reinvesting in the business. So that is very important. So these ratios like ROE and ROC is something which I try to see over a period of last 5 years, how the company has behaved in that. And fifth and the most important thing which I focus is the quality of the management. Yes. Now we can in fact have a separate session on this topic, but it's a very broad topic. But just to give you the brief, in short, how we assess the quality of the management is by just either interacting with them if there is an opportunity, or reading in between the lines in the annual report. Okay. So like one example could be, let's say if I want to understand how the intention of the management is, so I will just download the past 5 years of the annual reports. And let's say, for example, 2017 annual report, I start with the chairman's letter, and I'll see that, okay, the chairman has promised, the MD has said that, okay, this is the vision for the company. Let's say they are going to do 2x capacity expansion in next year, 2 years, and this will be the impact on financials. True. So then again, I open 2018 annual report. I'll see how much out of that promise they were able to deliver on. Was it 60%? Was it 70%? Or was it very low? And then I try to see a pattern over a 5-6 years, that, okay, what they are promising and how much they are actually delivering. So over this 5 to 6 years, you can find a pattern and you can see that, okay, how is the efficiency of the management. And during the con call, one hack I would like to share with everyone is that a CEO or an MD would always be very confident, but make sure you pay attention on a CFO while he's talking about the numbers. Okay. So these are the certain small things which one can use to assess the quality of the management. In fact, as I said, we can actually have a broad session on this. Too much I can talk about it, but I would like to stop here.
No, absolutely, Abhijit, and definitely we'll do another session and talk about all the 5 pointers that you've given to us. If someone is chasing the corporate dream, or how to analyze the new company, or how to analyze different companies. Well, on that note, thank you so much for your time, Abhijit, and that's all for now, folks. But do stay logged on to etmarkets.com for more on news, business, and economy. Again, thank you so much for your time.